Let's see a question on that. We will do only one question on inheritance tax, which is a very nice and comprehensive question, and it was examined in 2013. And this question examines almost everything which is in your inheritance tax syllabus, almost 70%, 80%. So we will do only this question in our inheritance tax. So let's start this question, and we will just do a part of it now. Then we will read the remaining notes. So it says, Afia died on 29th of October 2016. So she died on 29th of October 2016. Right. She had made the following gifts during her lifetime. On 14th of September 2015. Now it is gift during lifetime, right? So she made a gift on 14th of September 2015. Afia made a gift of 6,500 £1 ordinary shares in C Limited, an unquoted investment company, and the gift is to her daughter, right? So how many shares? 6,500 shares. Now after that it says, before the transfer Afia owned 8,000 shares of C Limited. C Limited's issued share capital of 10,000 shares. Now before the transfer she held 8,000 shares, which is 80% in the company, because the share capital of the company was 10,000 shares, so she held 80% in that company before the transfer. Now on 14th of September 2015, C Limited's share were £3 per share for holding of 15%. So if you hold 15% shares in a company, the price per share was £3. If you hold 65% shareholding, then the per share price was £7. However, if you hold 80% shareholding, then the price was at £8. Now you might be getting my point now, the example which I gave you earlier. So the more shareholding you have in a company, the expensive your per share price is going to be. The less shareholding you have in a company, your price per share is going to be less as well, right? So let's see, we have read the enough information to do this question anyway, to do at least this part. So if I ask you to give me the value of transfer, please, what is the diminution in value? Could you please tell me what is the diminution in value? Now let's see what is the diminution in value. So what we do, we will do transfer, value of transfer before transfer, value of shares before transfer less value of shares after transfer. That is the amount which is going to be diminution in value. Now she held 8,000 shares before, and the price per share was £8, right? So 8,000 multiplied by 8, that is value of shares before transfer, less value of shares after transfer. Now value of shares after transfer is how many shares she hold now? After transfer she will have 1,500 shares, and per share price is going to be £3, right? So 1,500 less 1,500 multiplied by £3, that is the value after transfer. So whatever the difference between these two is, that is diminution in value, and that is diminution in value, and that will be the amount which we will take as value of transfer, right? Now this value of transfer is very high, right? Why it is high? Because what's the name, Afia has already sold the expensive shares, because her shareholding in the company is just 15% now. So her shares per share price is not expensive now, because she has already sold the majority shareholding. Right, now we will read remaining part of the question later. Let's move to our notes now. I was just showing you how to calculate the diminution in value, right? So let's move forward. After that it says lifetime tax on lifetime transfers. We know that if it is potentially exempt transfer, if transfer from one individual to another individual, there will be no lifetime tax, right? As you can see on your screen as well, not on the screen, on the board, the information which you have noted down on your notebook, you can see that there is no tax during lifetime on potentially exempt transfer, and there will be no tax if individual survives for 7 years. After that it says lifetime tax on CLT. Now it depends on who is paying the tax, if the trust is paying the tax or if the individual is paying the tax. So if it says if transferee, trust pays the tax, so when CLT is made, chargeable lifetime transfer is made, and the transferee, the trustees, pays the lifetime tax. So what would happen in that case? Give me 1 second. So it says we will have to follow these steps to work out the lifetime inheritance tax on it. So first step is look back 7 years from the date of transfer to see if any other CLTs have been made, and calculate how much of the nil rate band is used while how much is remaining. Right? So we are talking about lifetime tax on CLT. We know that on CLT we will have to pay lifetime tax. Right? So how to do it? We'll take the value of the CLT and then we will see if we have made any other chargeable transfer within the 7 years period. If there are any lifetime transfer within the 7 years period, 7 years before the date of this gift, so we'll have to see if there are any other lifetime transfers within the 7 years period. Then them assets, them transfers will use £325,000 of nil rate band, and if there is any left of the available nil rate band, then we will use available nil rate band against this gift. Right? So this £325,000, it will be used first against the earlier gifts, and if there is anything remains at this date, then we will use available nil rate band against this asset as well. So that's what it says in the notes. Step 1, look back 7 years from the date of the transfer to see if any other CLTs have been made, because we know that pets are exempt during lifetime anyway, so we only have to see any CLTs have been made and calculate how much of the nil rate band is used while how much is remaining. Now we know if there is any nil rate band is available, now up to the available nil rate band, the tax rate is going to be at the rate of 0%, and any part of the CLT not covered by the nil rate band, and tax rate is charged at the rate of 20%. We know it is a lifetime tax, right? So the death tax rate is at the rate of 40%, and lifetime tax rate was half of at death, so lifetime tax is at the rate of 20%. Right? Now it was the case where the trustees, transferees will pay the tax. However, what about if the transferor pays the tax? Right? So the tax rate is going to be different. Exactly, we will calculate in exact the same way. However, tax rate is going to be different. Now, tax rate, if the transferee is paying the tax, is at the rate of 20%, whereas if the transferor is paying the tax, then the tax rate is at the rate of 20%. Now, why is that? Now, if I am a transferor, I am transferring to the trust, but I am saying to HMRC, please don't deduct the tax out of that amount of the gift. Right? I will pay the tax, but don't deduct out of the amount of the gift. HMRC will say, all right, okay, I won't deduct out of the gift, you pay me. Now HMRC thinks I might pay, I might not pay. Because HMRC is taking the risk of trusting me, and then that's why they are charging extra tax. If I say I won't pay, then they will deduct out of the value of the value of the gift, right? So if I don't pay, but if I say to HMRC, I am the transferor, please don't deduct out of the gift, and I will pay the tax. In that case, the tax rate is going to be at the rate of 25%, right? So extra 5% is because of the risk taken by the HMRC, because they are taking the risk so that I might pay, I might not pay. Right, so there are these steps, as you can see. So first we will see, look back 7 years from the date of the transfer if there are any other CLTs have been made. So nil rate band will be used against them first. Any available nil rate band we will use against this asset. Any available nil rate band up to that amount is going to be at the rate of 0%, and on excess of that is going to be at the rate of 25%. Work out the gross amount. Now this third step is additional one, as you have noted down from the whiteboard. As I showed you in the CLT section, if we look at the death tax on CLT, it says if individual dies within 7 years, you will have to pay tax, right? and we will have to take the gross amount here, right? So in lifetime as well, we will already calculate the gross amount so that we can use it against the death. So that's what it is saying in the notes. Step 3, work out the gross transfer by adding the net transfer and the tax together. This is the gross value of CLT on which the death tax will be calculated if the transfer dies within the 7 years period. Right, so that was the thing. Now these are the advantages of making lifetime gift. We will leave this one for now. We will come to this later. Let's read the remaining part here. It says death tax on lifetime transfer, pets and CLTs. Now we have already covered the lifetime tax. Now we are seeing the death tax. So how much tax we have to pay on death? So it says if the transfer dies within 7 years of making the pet, it becomes chargeable. We know that there is no tax on potential exempt transfer during death. However, if individual dies within 7 years period, then there will be tax on potential exempt transfer on death. Also, all CLTs made within 7 years period before the death will become chargeable for death tax. Note, please remember, calculate lifetime tax on CLTs first. So first thing is to calculate lifetime tax on CLT, right? Because there is no tax on pet during lifetime anyway. So first thing is we will calculate lifetime tax on CLT. Then move on to death tax, working through all CLTs and pets in chronological order. So whatever the date is, we'll have to choose that. Now follow these steps to work out the death tax on pets and CLT. So it's the same way, we'll calculate in the same way. So we'll look back 7 years from the date of each transfer to see if any other chargeable transfers of CLTs or pet have been made, and then we'll use the nil rate band first, and any available nil rate band we will use against this asset, and up to nil rate band, available nil rate band will have to pay tax at the rate of 0%, and on excess of that, the tax rate is going to be at the rate of 40%. But please remember, this is a death tax, so there will be separate available nil rate band. So there will be separate £325,000 nil rate band. Nil rate band is different for lifetime and for death. There are two different nil rate bands, and the amount is exactly the same: 325,000 during lifetime and 325,000 at death as well. Now, after calculating the death tax, what we have to do, that tax liability on death will be reduced by something called taper relief. And that tax liability will be reduced by taper relief. Now, what is the taper relief? Taper relief is given when individual has survived for just 3 years. So if individual has survived for more than 3 years, then the taper relief will be given. Now, survived for after what? Now, if individual has made a gift now and he survived for more than 3 years after making the gift, then the taper relief will be given. Now, the longer he survives after making the gift, the more taper relief will be available. Now it says reduce the death tax by taper relief if available. So if the individual has survived for 3 years or less than that, then the tax rate is at the rate of 0%. If it is between 3 or 4 years, the tax rate, the taper relief rate is 20%, and it will increase up to 80% if individual has survived for 6 years. What if individual has survived for 7 years? Yeah, you're right. If individual has survived for 7 years, there won't be any tax anyway, right? So if individual has survived for 7 years, there won't be any tax. After that, it says deduct any lifetime tax. Now please remember, we are calculating tax on CLTs, right? Death tax on CLTs. Please remember, we have already paid tax on CLT during our lifetime. Now we are again calculating on death, but we will deduct the tax which we have already paid during lifetime. So we will deduct the amount of tax which we have already paid during lifetime out of that, and the net amount is going to be the tax which we pay on death. Right? And another thing as well, give me 1 second. Another thing as well, it says deduct any lifetime tax paid. This will only be applicable to CLT because there is no lifetime tax for pet anyway. So that's why it's saying applicable only for CLT. Then it says the death tax may be deducted, may be reduced to nil, but there is no repayment. So if you have paid extra tax during lifetime, but your eventual tax liability on the death tax is less than that, so it can only reduce the death tax to 0. It cannot go into negative. So there will be no repayment if you have paid more. Right, death tax on death estate. Only thing left is death estate. So what is the death tax on death estate? And before we move to death estate, let me look at the advantages as well. So the thing which we left earlier, the advantages of making lifetime gifts. So what would be the advantages? So first thing it says, give me 1 second where it is. So first thing it says, if individual makes a PET potential exempt transfer, it will be exempt. So if individual makes a lifetime gift of potential exempt transfer, it is exempt, and if he survives for 7 years, it will remain exempt. Now if individual survives for 7 years after making the gift, it doesn't matter if it is PET or CLT, it is going to be exempt anyway. Another thing is that we will get some exemptions if we make a gift during lifetime. There are certain exemptions available, and these are only available if we make a lifetime gift. Then it says if the value of properties to be transferred is appreciating. Say for example, if the property which is transferred is a house or a piece of land, we know these are the type of properties which appreciate in value by the time. So if a property of the house is, I don't know, £100,000 now, it will be £200,000, might be £150,000 after 7 years or 5 years. So it's better to give during lifetime because its value will be increasing every day, and when it dies, if it does not give during lifetime, if it does not give during lifetime, then by the time he will die, the value of the asset will be increased, so they will have to pay more tax. So that's benefit if we give during lifetime. If the value of asset is appreciating, then we'll have to pay tax at the rate of reduced value. Then it says if the donor does not survive for 7 years, but he survives for more than 3 years, then taper relief will also be given. So the taper relief which we have just seen will also be available. And then it says factors to consider when you are giving the gift. You will have to figure out, we'll have to think some factors about some factors when we are giving the gift for inheritance tax purposes. And what are the factors? We'll have to consider whether we'll have to pay capital gains tax as well. So that is the thing we have to see. Another thing as well, if I make a gift during lifetime, will I be able to live in that house? Say for example, if I have only this house, I transfer it to my son during my lifetime, so I will have to think about my relationship with my son. He might kick me out of the house, so we'll have to think about that as well, so that whether I can live comfortably after transferring the asset. Right? So we've already done that anyway, so let's move to death tax on death estate. So there are 3 steps to calculate. So first thing is that compute the value of death estate, the pro forma which is given beneath that. Then it says look back 7 years. If any CLT or PETs have been made which have become chargeable, they will use the available nil rate band at death, work out the value of any available nil rate band. Now up to the available nil rate band, tax rate is at the rate of 0%, and in excess of that, tax rate will be at the rate of 40%. Now this is the pro forma of death estate. You will have to, when you see it yourself, so all the assets which individual owns at death, and we'll have to deduct all the liabilities as well. And on the net amount, we'll have to pay tax. Right? And it says exempt legacy to spouse. Now the amount which is given to spouse is exempt, so that's why it will be deducted as well. Now what the liabilities, if the individual has liabilities, so they will have to pay some debts. What are the expenses which can be deducted? Now these are the expenses which can be deducted, but there is one hard and fast rule that if there is no consideration, if it is said, if I said to someone that I will give you, £500, and if I die, an individual comes to my door and asks my son that, your dad said to me that I'll give you £500, he owes me £500, so please give me. Now that amount cannot be deducted because it was just, I said it orally, it wasn't written, and there was no consideration in that, so it can't be deducted. And there are certain things, other things as well, so you'll have to read it yourself. Then it says transfer of unused nil rate band. Now if individual dies today, and when the individual died, it did not have used all of his nil rate band. So for her nil rate band was, say for example, £325,000, she only used £300,000 instead of total £325,000. So the remaining nil rate band, remaining nil rate band of £25,000, that can be transferred to her spouse when he dies, right? So that £25,000 will be increased according to the new nil rate band right? Because by the time her husband will die, there might be new nil rate band. There might be, I don't know, £400,000 nil rate band. Now this £25,000 will be increased according to the new nil rate band. So that's what it says in the notes. If a person who has died had a spouse who died earlier with any unused nil rate band at her death, then the nil rate band on the later death will be increased by the unused percentage of the nil rate band of the earlier death. An election to claim unused nil rate band of the spouse must be made within 2 years of the death. For example, if individual had a nil rate band of £300,000 but B had an unused nil rate band of £30,000, this £30,000 unused proportion in percentage terms is 10%. 10% of £300,000 is £30,000 anyway. Now if A dies, it says, if A dies, then the nil rate band is changed to £325,000. If the nil rate band has changed to £325,000, excuse me, then B's unused nil rate band of $32,500 will be added to her husband, right, according to the new change, right? So after that it says basic tax planning for inheritance tax purposes. Donor must make use of available exemptions, so he must give the right time. Say for example, if his son is getting married, so they must use the marriage allowance and stuff like that. Donor should make gifts in early life so that there is less chance of pet becoming chargeable. Donor should consider making the use of available nil rate band, and after that donor should consider making the gifts to grandchildren so that he's skipping the generation. Please make sure you mark it as important, the last one. Donor should consider making the gift to grandchildren instead of children, thus skipping the generation and resulting in the reduction of the inheritance tax. So say for example, if I have to transfer an asset, instead of transferring it to my son, I will transfer it to my grandson. Because if I transfer it to my son, knowing that my son will eventually transfer to his son, then it's better to transfer directly to the grandson so that I will save some tax, because otherwise I will have to pay tax and my son will have to pay tax as well when he transfers to his son. So that's why if I skip a generation, I will save some tax. Then it says tax liability for of IST and due dates. So it says for lifetime tax on CLTs, because there is no tax for pets on lifetime anyway. So for lifetime tax on CLTs, the due date is later of 30th of April after the end of the tax year of transfer. So 30th of April after the end of tax year. Please remember, after the end of the tax year, it does not say after the end of the month or after the end of year. So 30th of April after the end of the tax year of transfer, and 6 months after the end of the month of transfer. So whichever is later of that, that is the date. Then it says tax rising on free estate death is payable by the personal representative or the executor. The time limit is 6 months from the end of the month in which the death occurred. Tax arising on death in potential exempt transfer, and if it is paid by donee, it will be paid within the 6 months after the end of the month of death. And then additional tax on CLTs on death is paid by the donee within 6 months from the end of the month of death. Now, excuse me. Please remember, for the theoretical point of view, and especially in MCQs, this basic tax planning, liability and due dates, and benefits of lifetime transfer, these are very, very important for these purposes, because examiner can examine, especially in MCQs, and he can also examine in big questions as well, but especially in MCQs he can examine, right? So we will do this question now, which we have seen earlier, question number 154, off year limited. So just off year basically. So it was examined in December 13. So let's read the requirement. It says calculate the inheritance tax which will be payable as a result of off year's death, and calculate the amount of inheritance tax which will be received. Calculate the amount of inheritance which will be received by off year's children. Right? So we'll have to do these. Let me erase this question erase this table so that we can do it on the board. It's not a difficult question, basically. You can do it as well. Most of the stuff is exactly the same which we have seen. There is nothing new in this question. Please read the question yourself as well now, so that we can do it on the board. And also, I'm going to cancel the share screen. Please come to this question on your exam kits. I'm using BPP exam kit. If you have any other, please make sure you find this question on your exam kit. Question name is AFIA, and it was examined in December 2013. So I'm just cancelling the share screen so that we can do the question.